Imagine looking out your living room window right now. Parked across the street, just sitting in your neighbor's driveway, is this brand new, wildly expensive cherry red sports car.
Oh, I can picture it.
Right. It is an absolute work of art. It's fast, it's pristine, and it is completely, hopelessly out of your price range.
Yeah, sadly.
But what if you didn't actually have to buy it to profit from it? Like, what if you could just call up an insurance company, take out a massive policy on that exact car, pay a small monthly premium, and then just wait.
Just waiting for disaster to strike.
Exactly. If a tree happens to fall on it, or if your neighbor totals it in a wreck, you get to collect a massive six-figure payout.
I mean, it certainly paints the picture of a pretty lucrative, if incredibly dark side hustle.
Yeah.
Just walking around your city, scanning the neighborhood for expensive things to secretly insure, and crossing your fingers for a disaster.
Right. But you can't actually do that. The entire financial system would just implode.
Mm-hmm.
And the legal rule stopping you is so foundational, it acts like the gravity holding the entire insurance world together.
It really does. It's everything.
So today, we are cracking open the study materials to explore this deep dive into a concept called insurable interest.
Huge topic.
Yeah, massive. Whether you are one of those people currently grinding through the exams to become a chartered property casualty underwriter, an industry pro, or just a beginner who wants to know why our society hasn't devolved into a giant morbid casino, this is for you.
Absolutely.
We're going to figure out what this rule is, how it secretly drives the mechanics of the economy, and the very specific logical traps that trip people up on the exams.
Yeah, because the law looks for this concept of insurable interest in every single policy. And if you strip away all the dense legal jargon from the study materials...
Which there's a lot of.
Oh, so much. But it really just asks one fundamental question. If this thing breaks, or if this person dies, does your bank account actually feel the pain?
Right.
The formal definition requires a genuine financial loss or a recognized personal loss. Without that, an insurance contract is essentially void from the very start.
So, to use a phrase from the sources,
Yeah.
It's about having actual skin in the game.
That is the perfect way to visualize it. Skin in the game is the prerequisite for protection.
Okay, let me test the boundaries of this because I want to see how far it goes.
Okay.
I am a massive fan of, a certain blockbuster movie star.
Okay, I follow.
I see all their films, I buy the merchandise. If something happens to them, I am going to be emotionally devastated. So can I buy a life insurance policy on them to soothe my inevitable grief?
The legal system shuts that down immediately.
Not really.
Yeah, sorry. Emotional devastation, admiration, or even being their absolute biggest fan. None of that creates a legally binding relationship. You have no actual financial stake in that actor's survival.
Because I don't lose money if they...
Exactly. Your bank account doesn't drop when they pass away. Without that tangible, recognized stake, you aren't transferring risk. You are engaging in what the law called a wagering contract.
A wagering contract. So, it's literally just gambling.
It is entirely gambling. You are taking out a bet on someone else's misfortune. And historically, like centuries ago, people actually used to do this.
Wait, really?
Oh, yeah. People would take out policies on the lives of prominent politicians or the safe arrival of random merchant ships they didn't even own.
That is wild.
It became a massive problem because it turned insurance into this speculative betting market. So the law had to step in and explicitly forbid using an insurance contract to create a profit opportunity out of thin air.
I see the logic there. If we could wager on anything, the incentives get completely twisted. But I want to move past the theory for a second. Let's talk about the actual mechanics. How does this rule function within the day-to-day machinery of a modern insurance company?
Well, think of the insurance industry as a massive chain reaction, like a domino effect. Insurable interest is the very first domino. It starts with underwriting.
Okay.
When someone applies for a policy, the underwriters are doing way more than just looking at the risk of the car or the house. They're verifying your legitimate relationship to it. If they fail to verify that you actually have skin in the game, the next domino falls, which is pricing.
Because the pricing data gets completely corrupted.
Exactly.
If I'm an actuary trying to figure out the statistical likelihood of a Honda Civic crashing, and half the policies are bought by people who don't even own a Honda Civic.
Right, they're just betting on crashes.
Yeah, then my math is completely ruined.
You've hit the nail on the head. That phenomenon is related to a concept called adverse selection. If the market is flooded with speculators, people buying policies because they actively want a loss to happen, not because they want protection from one, premiums would just skyrocket.
That makes total sense.
The entire pricing model relies on a pool of people who are actively trying to avoid a loss. Gamblers want the loss, so if gamblers enter the pool, genuine risk transfer collapses, and regular people wouldn't even be able to afford basic coverage.
And I imagine if the pricing collapses, the claims department can't function either.
Right. The third step in the chain is claims. Insurable interest ensures that when millions of dollars are paid out, that money is going strictly to the party who suffered the actual blow. It restores them, and that flows directly into regulation and risk management.
Which are the last two pillars.
Yep. State laws strictly enforce this because the overarching goal of the entire industry is to act as a stabilizing force for the economy.
So it's a safety net, not a lottery ticket.
That's a great way to put it. A safety net requires a fall. If you aren't the one falling, you don't need the net.
This brings up something the text highlights, and it goes right back to our cherry red sports car scenario. Moral hazard.
Oh, yeah, the big one.
Right. If I am allowed to insure my neighbor's car, my brain undergoes this terrifying psychological shift. Suddenly, I am financially incentivized for really bad things to happen to them.
The temptation becomes profound. I mean, if you stand to make $100,000 from that car getting totaled, you might suddenly forget to salt the icy sidewalk near their driveway.
Oh, wow.
Or perhaps you accidentally leave a pile of oily, highly flammable rags right by their garage.
The moral hazard would be absolutely off the charts. We'd have neighborhoods turning into these psychological thrillers where everyone is secretly sabotaging each other for payouts.
Which is exactly why the enforcement of insurable interest is so incredibly rigid. By demanding that you only insure what you can afford to lose, the system aligns everyone's incentives. You want your property to stay safe, and the insurer wants your property to stay safe.
So let's ground this in a very specific scenario from the study material so you can visualize the nuance here. We have the Sarah's house example.
A classic.
Yeah. Sarah owns a $500,000 house. Obviously, if it burns to the ground, her financial life takes a massive hit. She loses her investment.
Right.
So that potential for ruin gives her an insurable interest, and the company writes the policy. But if her neighbor tries to buy a fire policy on Sarah's house, they get denied, because the neighbor doesn't lose a dime if Sarah's kitchen goes up in flames.
It's a perfect, straightforward illustration. The neighbor might suffer some smoke inhalation or, a ruined view, but their bank account remains completely untouched.
Well, let me challenge this a bit, because I hear this and I think, isn't insurable interest just a fancy, convoluted way of saying ownership?
It sounds like it, yeah.
Right, like if my name is on the deed, I can insure it. If it's not, I can't. Why do we need a separate term for this?
That is a really critical assumption to challenge, and it's a distinction you absolutely must master, especially if you are studying for the CPCU exams. Ownership is the most common way to have an insurable interest, but it is far from the only way.
Okay, give me a scenario where I don't own the thing, but the law still says I have a legitimate financial stake in it.
Let's look at the housing market again. Think about your mortgage lender. If you take out a loan to buy a house, the bank does not technically own the property in the way a homeowner does.
Okay.
You live there, you paint the walls, your name is on the title, but the bank has injected hundreds of thousands of dollars into that transaction, using the house as collateral.
Oh, I see. If the house burns down, the bank's collateral literally goes up in smoke. The homeowner might just walk away from the loan, leaving the bank with absolutely nothing.
Precisely. They would suffer a severe, undeniable financial loss. Therefore, lenders hold a massive insurable interest in the property. This is the exact reason your mortgage agreement legally forces you to maintain homeowners insurance and list the bank on the policy.
So they are protecting their interest, not just your living situation.
Exactly.
What about other relationships, like business ones?
The same logic applies to landlords and tenants. If you rent out a commercial building, the landlord has an interest in the physical structure, but the tenant has an interest in the improvements they've made to the interior, or simply their ability to operate their business out of that location.
Makes sense.
Another great example is business partners. Two co-founders have an insurable interest in each other's lives.
Because if the tech genius of the company suddenly passes away, the company might go bankrupt, ruining the surviving partner financially.
Yes, they don't own their partner, obviously, but they have a clear, demonstrable financial reliance on their continued survival.
This brings us to a really elegant concept in the text that works as the flip side of the coin to insurable interest. Indemnity. If I understand the materials correctly, these two rules are permanently linked.
They are the twin pillars of the claims process. You really cannot fully understand one without the other.
Okay, let's try a metaphor here. Tell me this works. Let's say your financial well-being is a bucket of water, filled right up to the brim. If a fire burns down half your kitchen, someone has basically kicked over your bucket and half the water spills out.
I follow you so far.
Insurable interest is the rule that proves it's your bucket. You have to prove you own the water that spilled.
Love that.
And indemnity is the rule that dictates the insurance company will only pour enough water back in to reach the exact line you were at before the fire. They restore you. But they will never overfill the bucket because water spilling over the top represents a profit.
That is a brilliant way to conceptualize it. Insurable interest establishes the right to be in the room and ask for the bucket to be filled. Indemnity establishes the strict mathematical limit on how much water can be poured.
Got it.
Because if they overfilled your bucket, giving you a brand new, upgraded kitchen that costs twice as much as your old one, we are right back in the realm of moral hazard.
Because then I actually want someone to kick my bucket over.
Exactly. You'd be incentivized to cause a fire just to get the kitchen upgrade. So, indemnity ensures you are made whole, but no better off than you were a second before the disaster struck.
Okay, we have the theory, we have the mechanisms, we have the buckets. I want to shift gears and talk directly to you, the listener, about the real gauntlet here.
The exams.
Yeah. If you are sitting for CPCU 530 or any of the core exams, the test writers do not care if you vaguely understand the bucket metaphor. They construct incredibly clever traps designed to exploit the tiny loopholes in these definitions.
Oh, the examiners are notoriously good at drafting scenarios that sound completely reasonable to a layperson, but are structurally flawed under the law.
Let's work through these traps. Trap number 1. I'll call it papering your way in. Say I managed to trick an insurance company. I submit an application to insure my neighbor's sports car, I pay the premiums on time every month, and they cash my checks. Doesn't the mere fact that we entered into a contract and I hold this legal piece of paper magically create the interest?
It absolutely does not.
Really? Even if they took my money?
Even then, the contract is just paper. The act of buying insurance cannot manufacture an insurable interest out of thin air. The financial stake must exist in objective reality, completely independent of the policy document.
So if a loss happens, the insurance company will investigate, realize I didn't own the car, and just void the whole thing.
Yes, and that mechanism is backed by another fundamental rule you'll see in the texts, the principle of utmost good faith.
Utmost good faith, right?
Unlike standard business contracts where the rule is generally buyer beware, insurance requires both parties to be radically transparent. You are legally required to truthfully disclose your relationship to the risk. If you lie or obscure the truth to get the policy, you've breached utmost good faith and the contract is nullified.
You just can't fake the relationship.
Exactly.
Okay, let's look at the second trap. And according to the study notes, this is the most heavily tested nuance of all. It's the timing rule. When exactly on the timeline of life does this interest need to exist?
This is where people fail the exams. The timing rules are drastically different depending on the type of insurance we are talking about. The two main categories to remember are property insurance and life insurance.
Let's start with property. I insure a house. When do I need to prove my financial stake?
For property insurance, the insurable interest must exist at the time of the loss. It is generally required when the policy is issued as well, but the absolute non-negotiable moment is the exact second the loss occurs.
Walk me through a scenario where that timing actually becomes a problem.
Let's go back to Sarah and her house. She decides to move. On Tuesday morning, she sits at a title company, signs the paperwork, transfers the deed to a new family, and hands over the keys. She is officially no longer the owner.
Okay, she's out.
But she forgets to call her insurance agent to cancel her homeowner's policy. On Wednesday night, lightning strikes the house and it burns down.
Oh man, so Sarah still holds a valid paid-up policy on Wednesday night.
She does. But she cannot collect a single penny. At the exact moment the lightning struck, the time of the loss, her financial bucket was entirely unaffected. The new family suffered the loss. Sarah had no insurable interest at the time of the fire, so her policy will not trigger.
Because the risk transferred on Tuesday,
Yeah.
so her interest evaporated the second the ink dried on the deed.
Precisely.
That is so logical when you actually break it down. Okay, so property requires interest at the time of the loss. How does life insurance bend that rule?
With life insurance, the insurable interest must exist at policy inception only, meaning the day you sign the original application and the policy goes into effect. It does not need to exist at the time of the person's death.
Wait, really? That feels like it contradicts everything we just established about moral hazard. Why does life insurance get a pass on the time of loss?
It comes down to the way society and the law view the purpose of life insurance. Unlike a fire policy, which is pure indemnity, life insurance is often treated as a long-term financial asset, almost like an investment vehicle.
Give me a real-world example of how that inception role plays out.
Think about a married couple. They buy a house, they have kids, they rely on each other's incomes. They clearly have a massive financial and personal insurable interest in each other.
Right.
So one spouse buys a life insurance policy on the other. They pay the premiums for 20 years, but then they get a divorce. The financial interdependence is severed. The personal relationship might even be hostile.
So under property rules, the interest would be gone.
Correct. But if the law forced them to cancel that life insurance policy upon divorce, it would create an unjust windfall for the insurance company.
Oh, because the insurer would get to keep 20 years of premium payments and completely walk away from the end-of-life payout.
Exactly. It ruins the long-term financial planning the couple invested in. So the law compromises. It says, as long as the interest was genuine on day one at inception, the policy remains valid until it pays out, regardless of how relationships or financial stakes change decades later.
Wow. That is a massive distinction. Property is time of loss. Life is inception only. I can see a dozen ways a test writer could twist a divorce or a business dissolution scenario to trick you into applying the property rule to a life insurance question.
It is the classic trap. You have to read the scenario carefully and identify the line of business first.
Okay, I have one more scenario to throw at you.
Okay.
This is trap number 3 from the notes regarding beneficiaries. Let's say I buy a life insurance policy on myself. I clearly have an insurable interest in my own life.
Undeniably.
But the application asks me to name a beneficiary, the person who actually gets the check when I die. Can I name my neighbor with the cherry red sports car? And if I do, haven't we just recreated the moral hazard? Now my neighbor gets rich if I die.
I love how you found the loophole. You've hit on a very subtle legal distinction between owning a contract and directing its benefits. The short answer is yes, you can absolutely name your neighbor.
How is that legal? They don't have an insurable interest in my life.
Because the law separates the creation of the policy from the payout. We establish that the owner and applicant of the policy must have the interest. Since you are buying it on yourself, the inception requirement is met.
Right.
The contract is valid. It is not a wager because you are managing your own estate. Once that valid legal contract exists, it acts like a piece of property. And as the owner of that property, you have the absolute right to give the proceeds away to whoever you want.
So the beneficiary doesn't need to pass the insurable interest test.
Exactly. You can name your child, your best friend, a charity, or even your neighbor. The charity doesn't suffer a financial loss when you die, but because you owned the policy and you had the interest at the beginning, you can freely direct where the money goes. The legal filter is applied at the front door, the applicant not at the exit door with the beneficiary.
The front door versus the exit door. That is a fantastic way to remember it. Man, we have covered a tremendous amount of ground today, navigating from sports cars and driveways all the way down into the microscopic intricacies of contract law and timing rules.
It is a dense topic, but once you see the underlying logic, it really stops being a list of rules to memorize and becomes a cohesive system.
Let's bring all this complexity down to a single, memorable takeaway. If you are sitting in a testing center, staring at a convoluted scenario about business partners and property transfers, or if you are an underwriter looking at a weird application, ground yourself with one question. If this property is destroyed, or if this person passes away, does the person buying the policy actually lose something real?
That is the ultimate litmus test. Look for the financial pain.
If they suffer a genuine loss, they hold an insurable interest. They have the bucket, and the principle of indemnity will ensure the bucket gets refilled. But if they are just a bystander, hoping to cash in on a catastrophe, they have no interest. No financial loss means no insurable interest, which means the insurance contract is legally dead on arrival.
Mastering this concept alongside utmost good faith and indemnity is going to get you through those exams. But more importantly, it teaches you how to evaluate risk honestly in the real world.
And speaking of the real world, I want to leave you with a final thought as you step away from this deep dive. We've spent all this time dissecting the legal mechanics of insurable interest and how it prevents fraud. But consider how this seemingly dry technical rule actively shapes the moral compass of our entire society.
It's pretty profound when you zoom out.
It really is. Because of this one specific boundary, our massive global financial systems are forced to focus their immense resources on restoring communities. The machinery of insurance is legally bound to fix what is broken and put devastated people back on their feet after a disaster strikes.
Right.
If this rule didn't exist, if wagering contracts were still legal, those exact same financial systems would allow and economically encourage individuals to secretly place bets on tragedy, cheering for their neighbor's downfall just to build their own wealth.
It would be a very different world.
So the next time you look out your window and see that wildly expensive sports car, you can admire it, you can envy it, but thanks to insurable interest, you can't secretly hope a tree falls on it. Until next time, keep exploring.